Hello there. Let's talk about computing income and income taxes today. First, a couple definitions. Your gross pay is going to be your total income. That's with no deductions or taxes withheld. Your net pay is what we call your take-home pay. So that's your pay with the taxes subtracted. Your adjustable gross income, also called the AGI, is something that the IRS uses on your federal income tax form. This is your gross income minus certain deductions. Now, deductions that are allowed would be interest on any student loan that you're paying back, alimony payment, or if you paid into a tax-deferred savings plan like a traditional IRA. The taxable income that the IRS uses is your AGI minus any personal exemptions for each individual in your household and your itemized or standard deduction. Now, exemptions are going to be a certain fixed amount of money that the IRS allows you to subtract from your gross income, and that saves you money on taxes. The standard deduction is a fixed amount of money that can be subtracted from your adjusted gross income. The itemized deductions, though, are separate amounts of money. People sometimes itemize their deductions instead of taking the standard if they have a lot of individual payments that they've made for mortgage interest on loans. Possibly they gave to charities. Possibly they had a lot of medical or work-related deductions. Sometimes these add up to be more than the standard, and that would be helpful. Now, your federal income taxes are a percentage of your income that our government collects to fund all of its services and programs. But the FICA taxes, FICA, stands for Federal Insurance Contributions Act. This was passed so that money is collected from each employee, and it's used for your Social Security and Medicare benefits. So we pay into the government so that when we are age 62, 65, 67, 70, or whatever the age is at that time, we are allowed some monies back on a monthly payment, and the health insurance for the elderly is called Medicare. Now, to calculate your income taxes, first you would normally find your adjusted gross income, which is your gross minus any of those adjustments like traditional IRAs. Then you are allowed to take your AGI and deduct your personal exemptions for every person in the household and either your standard or itemized deductions. And lastly, you would have to compute the taxes. Normally a table is used for this, but most people just use a software program now. And some people are allowed tax credits. You may have heard of the Earned Income Tax Credit or the Child Care Credit. Those are all credits that you can use to put towards your income taxes that you owe. Now for some examples. In this first example, you're just going to calculate your gross pay from your employer. You are paid $8.70 per hour and you work 23 hours. To calculate your weekly gross for this given week, you just multiply 23 times the $8.70. That will give you a gross pay of $200.10. Now, in this second example, we are going to involve some taxes. Here we have a gentleman called Homer Simpson who finds himself in a panic attempting to meet his April 15th federal tax deadline. If Homer and his wife had an income of $60,000, they earned $1,200 in interest, they invested $2,500 in tax-deferred savings plan, that's important, and they have a total of $12,000 in exemptions and deductions, what's the taxable income? Well, you start with the original gross income of $60,000. In addition to that, they earned $1,200 in interest. So we would add that together. However, the $2,500 was in a tax deferred plan, so the government will allow us to subtract that since it was in a tax deferred savings plan. They also have exemptions and deductions. These are things that we can subtract from the money that we owe. So if we take these amounts and total it up, it looks like we end up with $46,700, and that would be the taxable income. Now, did you know that in addition to federal income taxes with the IRS, most of us also pay state income taxes? We pay this directly to the state in which we live or work, and some states do not have income taxes. Currently, the states that are listed here on this screen do not collect state income taxes from their residents. That is why these particular states are very attractive to people, especially if they wish to open a business or retire, because it is a tax savings. Now here's another example. A woman earns wages of $55,600 and receives interest from a savings account. So these two monies will add together in the eyes of the IRS because that's money that she received. However, she contributed $2,500 to this tax deferred. Now you realize that's something we can subtract. She was also entitled to a personal exemption of $3,800, so we can subtract that, and a standard deduction of $59.50. We can subtract that. The interest on her home mortgage was $7,500. She contributed $2,400 to charity, and she paid $19.75 in state taxes. Normally, if your state does charge you income taxes, then you're allowed to deduct that from your IRS monies. Now, we're asked to find three different amounts. First, the gross income amount. The gross is just her total income. So her earnings, $55,600, plus the interest that she earned would be her gross. So her gross income is $58,100. Now we want to do the AGI, adjusted gross income. We will take her gross that we got from the first answer, and we will subtract any of the tax deferred money. So we have $2,500 subtracted, and this gives us a tax deferred amount of $55,600. Lastly, we want to find out her taxable income. We will take the AGI, $55,600, and we have two options. We can go the standard deduction, or we can go the itemized deduction. Most people will go with whichever option will have them with less taxable income. The less your taxable income is, the less taxes you have to pay. So let's examine it both ways. If we go with a standard deduction, then we take her money, $55,600, we subtract the personal exemption for herself, and we subtract the standard deduction. That will give her a taxable amount of $57,750. However, if we use the itemized amount, we take her adjusted gross income. We can still subtract the personal exemption that she had, but instead of the standard deduction, we won't take that this time. We will subtract her itemized deductions, which is $7,500 of mortgage interest, $2,400 given to charity, and $1,975 that she paid in state taxes. Now in this case, when we subtract, her taxable income is $39,925. Her preference would be to go with that lesser amount. Now we're going to look at reading a tax table and computing the tax for an individual. Here is a tax table from the year 2012, and if you notice, it's broken down into these tax rates. If our gentleman, who's a single man, has a taxable income of $65,000, $65,000 falls in the 25% tax rate, because here where it says single, his amount of gross income would fall in that range. So we call him the 25% tax rate. However, he does not pay 25% on all of his money. He would first pay 10% on the first $8,700. So I will say 10%, which is 0.10 times 8,700. That's his first $8,700 of gross income. Then he will pay 15% on the money from 8,701 to 35,350. So I will add to this the 0.15, so he has to pay 15% on this. Now to get this amount, you will take the top boundary, which is 35,350, and you will subtract the boundary on the previous tax rate, so minus 8,700. So that range of money he pays 15% on. Lastly, he pays 25% on the upper amount of money. So from $35,351 to his $65,000. To determine exactly how many dollars that is, take his gross pay, $65,000, and subtract that upper range, which was $35,350. Okay, when we calculate this, the 10% amount, when we multiply that, gives us $870. The 15% amount is $3,997.50. The 25% amount is $7,412.50. So this gentleman's total tax that he will owe would be the sum of these, which is $12,280 in taxes. Now, let's go ahead and look at FICA taxes. Remember, FICA taxes are taxes that we pay so that when we reach retirement or an older age, we will have some income coming in the form of a Social Security monthly payment, and we will have some type of older health insurance. Now, the interesting thing is a self-employed person must pay the entire FICA tax burden. But if you have an employer, the employer pays part and you pay part of that. So in this example, you are not self-employed. So if you're not self-employed, you will use this portion of the chart, the employee's rate. Notice over here that the self-employed has to pay a higher percentage. Now we are earning $178,000. Notice you pay 5.65% on the first $110,000. So our FICA taxes would be 0.0565. Remember, 5.65% is equal to the decimal 0.0565. Just move that decimal over 2 places. And we would multiply that times 110,000. That's the upper limit on that first range. Then I have to add to that this second part, this 1.45 of income in excess, because we had in excess. So that would be 0.0145. And to get our excess, we would take our gross 178,000 minus that upper limit number, and we calculate this. When we calculate this, we end up with $7,201. I hope this has explained a little more about calculating your gross pay, your adjusted gross income, your taxable income, and a little bit more about taxes.